We think that Hurricane Florence is going to model something like Hurricane Hugo, which hit the Carolinas back in 1989. That was about an $8.5 billion event in today's dollars. So we have a 6 to 11 range on this event. We've been watching it closely. Landfall looks to be north of Wilmington. And that's not a terrible place for a landfall. And increasingly, the wind speeds look a little bit lower, but it could change. And we watch every update, every 6 hours. For as far as the stocks, Allstate, AIG, Travelers are the large cap names that have the most exposure. We also look at exposed reinsurers. As a group, they've traded down about 3 to 4% ahead of this landfall. Today, they're flat because the wind speeds have come down, and we'll watch it closely. Usually, these stocks trade down, they trade up after landfall if the event is not as bad as expected. But sometimes, like we saw with Sandy, it can be worse than expected. So our expectation is the stocks stay under pressure until we see kind of an all clear on the storm, either breaking up or weakening ahead of landfall.
This time last year, we were just cleaning up and recovering from 3 very big and very disastrous hurricanes. Took a huge earnings hit out of the insurers that had exposure to that. Have they been able to raise premiums enough to be able to be well capitalized and be able to offset any impact from a storm like this if it's as bad as could be predicted?
Yeah, that's a good question. And I mean, the answer is yes and no. So a lot of capital from institutions and pensions globally has come in to take the place of the over $100 billion of catastrophe losses that the industry had last year. Companies can raise prices, but it's hard for those incumbent writers, so the Allstates, the AIGs, the Travelers of the world, to make up for it enough in price. And so we think they see margin compression on this. All of this should be easily absorbed within our expectations of catastrophe, and some reinsurance programs will be triggered. But the net of it is there's plenty of capital out there writing property casualty insurance. So at this point, I don't see this event as a big game changer for the industry. Last year, there was 3 major hurricanes, as you said, and that barely made a dent in industry capital.
Randy, step back from Florence for a moment. What do you think about the sector broadly, and what's your top pick at the moment?
So I cover property casualty, life, and mortgage insurers. I actually like the life and mortgage insurers a lot more. We really like the housing market on the MIs. For life insurers, I think they're inexpensive relative to what we've seen with higher yields. With property casualty insurers, we have neutral ratings on all the stocks that I just discussed. I think that that influx of capital that comes in every time there's an event prevents these companies from kind of earning these losses back. And I think that the industry, the property casualty industry, is going to be in a kind of a soft pricing environment for the foreseeable future where margins are compressed. So, people trade these stocks around, and we try to help you all understand that through these storms. But it's taking a step back. I think the industry is challenged by margin compression.